everyone, this is Bharti Bhardwaj and I have come with a short revisionary video on chapter of single interest system accounting from incomplete records. I have all how to deal with this chapter and basically the conceptual, it might help you in your conceptual clarity, because when many of my fellow friends find it difficult, they think a lot of accounts had to be prepared and they have to keep a lot of things in consideration while preparing accounts. So my friends, is this chapter is the most easiest chapter because it's totally based on our 11th and 12th journal entries, which we have already learned in our 11th standard and 12th standard. So yeah, if you're well versed with the journal entries, this is the most simplest chapter and it carries a good weightage in our examination. So why to miss it? So what is this incomplete records? Incomplete records is not maintaining a proper records. So we prepare final account from trial balance. So how trial balances, how we reach to the trial balance? We record, first is recording of transactions in journal, then posting them to ledger, and from ledger we prepare trial balance, and from the trial balance prepare final accounts. What is final accounts? Final accounts is trading, profit and loss, and balance sheet account, right? So when it comes to incomplete records, it is generally maintained by the small proprietors or trader. They don't maintain the proper books of accounts because they don't have the knowledge of it. They basically maintain a summary of sales, purchase, cash transactions, bank, etc. So what you have is totally incomplete information, the left out information from which you have to prepare the final accounts. So how we have to deal with incomplete records in preparation of final accounts, this chapter talks about it, right? So the features is like it is inaccurate, unsystematic method of recording the business transactions, and it is totally based on the convenience of the proprietor. Why I'm saying is this is totally based on the convenience of the proprietor, because they record all the transactions to the extent of their convenience or need. Okay, they don't record all the transactions. I would like to give you an example. For example, the proprietor gives certain amount of quantity of stock to their relative free of cost, right? So they don't record the transactions that they have given that goods free of cost. Inventory has reduced, but for them it's immaterial. They don't consider it material. They haven't recorded it. And so and the profits based on incomplete records is totally based on estimations. They're like, you're valuing inventory, but the method of valuation of inventory, then calculation of value of fixed assets, the method of depreciation, they don't have knowledge of it, and it might be at a very high possibility that they might not follow these methods, principles or policies. So their profits are totally based on estimations. There is no proper recording of accounts from incomplete records. We prepare statement of affairs. What is statement of affairs? Statement of affairs is a kind of balance sheet, but we prepare statement of affairs for finding the capital balance. Capital balance is like the opening balance or the closing balance. Okay, so this is basically a statement of affairs is surplus of assets over external liabilities, which is represented as balance. So did you understood this? The last sentence which I told you? No, right? So surplus of assets over external liabilities, what remains is the capital. So we find the capital from statement of affairs, right? Because liabilities, we have capital, then profits, then additional capital, then non-current liabilities, then current liabilities, right? And for assets, we have non-current assets, then current assets. So surplus of assets after deducting the outside liabilities, that is non-current liabilities and current liabilities, we find it capital. The balance remains as capital. So I would like to show you the differentiation between statement of affairs and balance sheet. I will share my screen with you all, guys, and we'll move ahead. I'll share my screen with you, and accordingly we'll move ahead. So yeah, here we are. So this is the differentiation between statement of affairs and balance sheet. So statement of affairs is prepared in single entry system and balance sheet is prepared in double entry system, right? So, because in double entry system we maintain proper books of accounts, the purpose of preparing statement of affairs is to compute the capital balance in the beginning and end of the accounting period. I just told you a minute before. And for preparing balance sheet, we always prepare balance sheet to find true and fair value, like the financial position of the business at a particular date. We prepare balance sheet to find the financial position of the business at a particular date. You would have already read at many places that it should depict true and fair position of the business. Balance sheet dash should depict, so that's balance sheet should depict true and fair position of the business. Reliability statement of affairs is prepared from incomplete records, so it's not more reliable, right? So it's totally based on estimates and assumptions of the owner or accountant's memory. Accountant's memories come when supposingly you have lost your records due to fire. So what remains is the memory of the accountant, what he remembers. Based on it, we prepare the final accounts. Then, yeah, balance sheet is more reliable because it is based on proper maintaining of books of accounts or records. I would say bookkeeping system, the records, and it's more dependable, right? The capital here in statement of affairs, how we find capital is the balancing figure. Balancing figure is what? Surplus of assets over external liabilities. And here the balance sheet, in balance sheet capital we find from ledger, we find it from ledger, the balance in ledger. All right. And then the omission, there is high possibility of omission. For example, I gave you the example of giving your stock as gift, or I would say charity donation, and you don't record it, but there is no possibility of omission because the balance sheet will not agree. If you will omit the transaction anywhere, for example, you have recorded in journal and you haven't recorded in your ledger accounts, or you have recorded in ledger but you haven't recorded in trial balance, then the balance sheet will not agree, right? Now the basis of valuation is in statement of affairs is totally based on estimated basis, because I told you before, the valuation methods which they are following is not disclosed. They prepare totally on estimations. But for balance sheet, appropriate value, that is cost, fair value, NAV, is recorded as per generally accepted accounting principles. So basis of valuation is disclosed in notes to accounts. So from there, this differentiation you can easily find a good difference of statement of affairs and balance sheet, right? So let's move ahead. Yep. So this is a perform of various accounts, but before this I would like to explain you this. We find profit, we compute profit, right? We compute profit by capital comparison method. So what is capital comparison method? Capital comparison method is difference between capital balances. Capital balances at the beginning and at the end. Beginning and end. The difference of capital balance of beginning and end represents your profit. This is your closing capital. I would say difference between your opening capital minus closing capital represents your profit during the period, right? So I'm finding it quite difficult. This is a profit. All right. So next, how we have to find the profit from opening and closing balance. In the question, you might be given with the capital balance in the end or capital balance in the beginning. both the capitals will not be given. So how you have to find the capital at the beginning of the period or at the end of the period is, for example, you have given capital balance at the end of the period. So for end of the period, you have to add back all the withdrawals you made during the year to arrive at the capital which was earlier with us, earlier with the enterprise. So we'll add back the amount withdrawn, drawings, okay, and we will reduce the amounts, we'll subtract the amount which we additionally added into the business, invested into the business. This is because we are reducing this because this was not present earlier into the business. So we have to arrive at opening capital. Beginning of the period is capital at the beginning of period is the opening capital. So to come at opening capital, we have to reduce back the additional amount of capital which we invested because this was not present earlier, right? This wasn't there in the business earlier. Then you come at the net balance, and for finding the profit, by this you will be finding the capital at the beginning of the period. All right, one second, I'll repeat this again. After adding back drawings to closing capital and reducing the additional capital, we find capital at the beginning of the period. And to find profit, we subtract. For example, I'll just write here, we take the difference of opening capital and closing capital. We take the difference of opening capital and closing capital and find the difference. We find the profit during the year. And yeah, here alternative you can prepare using capital account, right? And okay, let's come to this thing, the accounts. While we prepare accounts, we all know if any of the adjustment is given outside, like below the question, that's adjustment. Any of the item or any of the transaction is given in adjustment, it has dual aspect. It has dual aspect means it is recorded twice. That means it is recorded at two places. For example, your fixed assets have been depreciated by 10%, and your earlier fixed asset was of rupees, for example, 10,000. Now it is depreciated by 10%, so that the depreciation will be charged to profit and loss account, plus it will be shown to the closing balance sheet and as a reduced balance, from the fixed assets in our closing balance sheet, right? In our closing balance sheet, right? So this was, I told you that any of the thing which is given in adjustment, any of the transaction which is given in adjustment has dual aspect, it is recorded twice. And any of the transaction which is already given in the opening balance or opening balance sheet or in or in trial balance, it has only one single effect, right? So here these are the accounts which we prepare in our working notes. So I'll explain you the accounts, in what manner it is used. For example, you are given with the opening balance of, in the question you are given with the opening balance of fixed assets, and you have to find the closing balance. So in the question it might be given, or even for example you have given with closing balance. So you have to find the amount of assets purchased during the year or sold during the year. For example, it is given the sale proceeds of assets is so and so. So you have written as buy bank or cash, because when you sell the asset is credited, so cash or bank account debited to fixed assets account. So buy bank or cash, sale proceeds of assets, and if we have profit, we have received profit from the asset, we recorded in debit side, and if we have loss, we recorded in credit side. by P&L account. This is because profit and loss account, because it is charged to profit and loss account, profit and loss account debited to fixed assets account. That is loss on sale of assets. And if you have profit, you record it on debit side of the fixed assets account. And after every other thing, the balance which remains as the balancing figure, this is the balancing figure. This is the balancing figure. So the balance, let me write it properly. This is the balancing figure. The balance which remains is the amount of fixed assets purchased during the year. Amount of fixed assets purchased during the year, right? So this is how we use our fixed assets account. Next comes is investments account. Investment account has the same thing. This is also the assets for an enterprise. You have opening balance, you have closing balance. If you don't have a closing balance, you will be given in the question with the say if the investments are sold, at what price it is sold, what was the value of the investments. It will be given the historical value, and you have to find from the amount received on sales and the value which was recorded last in the balance sheet. The difference shows your profit and loss. If it is profit, it's shown on the debit side of investments account to P&L account. If it is loss, we record it as by P&L account. That is P&L account debited to investments account. Then sundry debtors account. Sundry debtors account is like I will explain you the sundry debtors account, which is quite important again. For example, you will be given with the balance brought down. This is the opening balance. So, and this is the closing balance. If you are allowing any discount, so it is reducing that amount of debtors. So, discount allowed debited to sundry debtors account. Discount allowed is what? Nominal account, right? Debit all the expenses and losses, credit all the gains. So by discount allowed is discount allowed account debited to sundry debtors account. So we record it as by discount allowed or rebate allowed. And if you are receiving any amount from the debtors, you'll record it as by cash or bank, that is collection during the year. If you are accepting if you are issuing any bills receivable which is accepted, you'll record it as bills receivable account debited to the name of the customer or the debtor, right? So bills receivable account debited to the to sundry debtors account. And if the same gets dishonored, so again, if this gets dishonored, again you will record it as to bills receivable account, because again this sundry debtors account, he will again become your debtor and you'll record as to bills receivable account. And this is discount allowed, I explained you. Sales return, we recorded sales return account debited to sundry debtors because the amount of debtors have again reduced from this. And the balance which we get is the credit sales made during the period. So from here we find credit sales, and sales is recorded in a trading account, right? Sales is recorded in a trading account. One second. Sales is recorded in a trading account. On the credit side, right? Trading account. I am writing trade. All right. It's quite difficult. So yeah. And then next comes the bills receivable account. This is the opening balance, closing balance. If you are discounting any bill, so you're giving the bill and you're taking the cash. So cash is coming in, bank, cash or bank account debited to bills receivable account, discounted during the period. And here you'll write as bills receivable account debited to sundry debtors account when you are receiving any bill, discount, allowed, or rebate, it's all the same concept based, such as of debtor. And then, yeah, if you're endorsing your bill, if you're endorsing your bill to your creditor, for example, A has A has received bills receivable from B, and A has to make the payment to C. So A will endorse the bill to C. Now B will pay directly to C, right? So if you're endorsing to your creditor, so it will be sundry debit the receiver, sundry creditors account debited to bills receivable account. And from bills receivable account, you can find the amount of bills accepted, or the closing balance of bill, or like any of the information which is not given in your question. The balancing figure will be your finding. Okay. Next, cash or bank account. Again, opening balance. For example, here you have to find the closing balance. So closing balance will be a balancing figure. Firstly, this. All right. And then next is sales is cash sales. In cash account, will record all the cash transaction. Collections from debtors, bills receivables, and creditors, check dishonored. If your checks issued gets dishonored, again this will you have to pay the amount to the bank. To miscellaneous income, rent, interest, dividend. For example, this check issued dishonored, I like to explain you. For example, you're getting your we'll take bills receivable. Okay. For example, you've discounted that bills receivable from the bank and you have received certain amount, and you have paid discounting charges. This is one case. The other is you have endorsed it to someone else and he has discounted the bill, or he has not even discounted the bill and it has got dishonored. So you have to pay certain charges to the bank. So that's your expenditure. So you'll be paying that expenses. Here it is this. I'll show you. It might be mentioned. Yeah, check dishonored. Again, he will become your debtor and you have to pay the amount. And fixed assets account is proceeds from sale, investment, all the if you have received any loan, so cash or bank account debited to, for example, you have taken loan from A, so to A, cash or bank account debited to A because A is now your creditor. You have to pay back to him. If additional capital is introduced, you show it as cash and bank account debited to additional capital. And purchases, cash purchases, when you purchases account debited to cash or bank, payment to creditors, payment to bills payable, and sundry debtors, check deposited or dishonored, again your debtors will be debited to cash or bank, as you'll pay the charges or the amount to the bank. Sundry expenses, rent, wages, salary, fixed assets, any of the additional and the same thing, right? This is the loan account, loan installment repaid, and this is how we show it. Drawings, if any, if you withdraw any of the amount. So this is all about accounts we prepare as our working notes. So this is all you'll be given with the information. This is a total, I would say, everything included in this account, right? So any of the informations will be given in the question, and the remaining, for example, you find the closing balance of cash or bank. This closing balance will be depicted in your closing balance sheet, right, on 31st March. So this balancing figure will be stated over there. So in question you will be given with the information, and accordingly when we prepare this accounts, we find the balancing figure. And Yeah, this is now the loan liability account. For example, you have taken loan from someone, so buy balance BD, opening balance, right? And if any installment is paid, so that particular amount of loan is reduced. So you're paying that loan or liability account debited to cash or bank account because that liability is being reduced. If additional loan is taken, then again loan is increased, liability is increased. So cash or bank account debited to liability account or the lender's account, lender's name account, sundry creditors, bills payable. Anything new which I can explain you out of this is, yeah, expenses account. When it come to expenses account, we write expense in P&L account, right? We write all the indirect expenses in profit and loss account and all the indirect income in profit and loss account credit side. So for indirect expense, if you have, let me just reduce the size. Yeah, if you have the opening balance of prepaid expenses, we write it as, for example, 3000 is your prepaid expense which was paid last year but paid for example 6 months during the current year, paid for current year which is paid well in advance. So to balance brought down to balance, this is the opening balance of prepaid expenses, right? And this is expenses payable, this is outstanding balances liability. See, prepaid expenses are, or the prepaid expenses is our asset, right? We recorded on asset side of the balance sheet, we record on asset side of the balance sheet, and the outstanding transaction is our liability. So we record in the liability side of the balance sheet as outstanding loan or outstanding wages, for example. So the any amount which is prepaid is shown in the debit side, payable outstanding liability balance is shown on credit side. So from here either we can find the closing balance, or if this closing balance is given, that is closing balance of amount payable or closing balance of prepaid expenses, if we have paid this time also in advance for the next year, so this might be given. So out of this, these are the, for example, these things are given, right? So the balance which we can make out from this account is total expenses during the year, made during the year, or total expenses paid during the year. So for expenses account, we can find as total expenses made during the year, which we will charge to P&L account. Charge to P&L account is debit side of P&L account, that is to expenses, right? Profit and loss account debited to expenses, and if we have paid during the year, this is the total expenses recognized in, if this is the amount of expenses paid during the year. Yeah, and if you find this difficult, you can alternatively prepare this prepaid expense account and outstanding expense, this is a liability account, separately. Recognized during the year in P&L, we recognize in P&L, right? And we receive in our anything which I need to explain you. Here comes the trading account. I'll explain you again this other income P&L item. This is the opening balance of income receivable. This is the opening balance of income received in advance. For received in advance, it's our income. For receivable is also our income, but we haven't received till now. This is the income, the closing balance you are given with the closing balance. So this is the amount which we recognize during the year, and this is the amount which we have received totally during the year. Trading account comes First we record opening stock, purchases, direct in trading account we record all the direct expenses, sales, we record net sales. If we are given in the questions with sales written, we subtract it from this sales written and we record the net sales, abnormal loss if any, and then all the indirect expenses are recorded here, indirect income is recorded here. Then comes the balance sheet. In balance sheet, first we write capital account, this is long and loans and liabilities and non-current liabilities. For this capital account, either we find from the balancing figure or for example I told you earlier, let me show you, yeah, either it might be given in you in the question that capital at the beginning, capital at the end of the period, or you will find from this information, that is adding back, if you have to, supposingly you have to find at the end of the period, you have to find the closing capital, right? So how you'll find it? You will be given with the opening capital. So in opening capital, you will add back closing capital. You'll add back additional capital. I'm sorry. You'll add back additional capital and you'll reduce drawing. So you'll come with the closing balance, that is at the end of the period. The balances which you're finding as balancing figure, side by side record in your trading and P&L account, or I would say the balance sheet which you are preparing. Otherwise you can miss out from some of the items and your balance sheet will not tally. So this is your current liabilities and this is your current assets, and hence this chapter gets finished off. And one more thing we record, I need to tell you an important point of sundry debtors. Debtors account. While preparing debtors account, we don't record bad debts recovered, provision for doubtful debts, and cash sales in debtors account. This is because there is no role of debtor. There is no role of debtor in preparing provision of debtors account. We'll subtract provision for doubtful debts and the net balance will record in our closing balance sheet. Because nowhere debtor is involved, so we don't record in our debtors account for the bad debts recovered. If you're recovering, for example, you're recovering your bad debts. If you're recovering your bad debts, it's like cash or bank account, cash is coming in to bad debts recovered, right? And for cash sales, it's like cash account debited to sales. And for preparing any provision, you charge it to P&L account. For preparation of any provision for doubtful debts, you charge it to P&L account and you write as P&L account debited to provision for doubtful debts. So here nowhere debtor is involved. Nowhere debtor is coming into picture. So we don't record provision for doubtful debts, bad debts recovered, and cash sales in sundry debtors account. So I feel you will be cleared with this concept. Why don't we record provision for doubtful debts and bad debts record in sundry debtors account? And yeah, here we are and we have completed this chapter. I'll show you that provision for doubtful debts a question. This question came in May 2008. So this is the opening provision for doubtful debts which we have written as by balance BD. A sum of 10,000 was written off as bad debts. When the amount of bad debts was written off, so it will be written off from the provision for doubtful debts. So provision for doubtful debts account debited to bad debts written off account. Right? 10,000. So the closing balance of sundry debtors is 6,30,000. We are given with the closing balance, but before that it is said in the question that it was only 10% of the debtors is to be maintained as provision. So the balance will be 10% of the debtors, that is 6,30,000. The balance will be 6,30,000, that is 10% of the debtor, and the remaining amount will be charged to profit and loss account as 22,000. If you have any doubt, put in comment section below. I'll solve it as early as possible. Alright, and practice n number of the questions. All are if you can understand the accounts, you can easily solve the questions. And each and every question is of same type. You have to just prepare the accounts, whatever is see whatever adjustment is given in the question. For that, definitely you have to prepare as the ledger account as a working note. That's all. And when you'll prepare the ledger account, you'll find the balancing figure and your problem is solved. You have to just put it in your trading P&L account and balance sheet. That's all, and it's over. It's very easy. If you have any doubt, put in comment section below and I'll solve it. Okay, till then, bye bye. Take care. Keep studying. Keep smiling.